John McClain is a portfolio manager from Diamond Hill Capital Management. John, good to have you back on the show. Would like you to weigh in on the conversation we were just having here, because it seems like some of the hot button recessionary worries of this year are starting to abate. Yet this morning I see bonds and gold back up, even though Germany skirts past recession, and that was what we heard was going to drag all of Europe into recession.
Yeah, well, 0.1% on GDP really isn't that great, honestly. And I still think that we've got a divergence between economic reality and asset prices. And that's really being propped up by the central banks across the globe. Quantitative easing has really distorted asset prices from what we're seeing in terms of economic data. And the conversation continues to be around the same topics: Brexit, tariffs. And there's no resolution in sight. So I think people have really just become apathetic and are hoping that we continue to go along in this long bull market.
Not to get too micro and short term, John, but we've divided 2019 into two segments. One is the first 9 months of the year, bonds, gold, stock valuations, all moving together. The last 2 months, bonds of gold have reversed pretty strongly. Now, over this past week, as maybe some cracks form in the U.S.-China discussion, no updates on Brexit, to your point, you've got this bid that's come back into bonds a little bit. But the question again about the euro and how it connects to this market is, 3 months ago or 4 months ago, people thought the world was ending. I mean, aren't markets relative? If Germany's not actually going into recession, and if trade is not escalating to the downside, then should we not continue to see some relief to some of these trades?
Well, again, it's technical definition of recession, but Eurozone economy is slow growth, if no growth, and might flip-flop between contraction and expansion, similar to kind of what we've seen with Japan for a long period of time. But again, the economic data is not good. And what we've seen is really there's been no EPS growth this year in the S&P 500. So what's really driven the returns has been margin expansion, the PE multiple, most importantly, and that's been driven by lower rates and sentiment that says low rates, good for equity multiples. When is that going to change? And people are going to say low rates mean low growth / no growth. And we're right on that inflection point, because you've had the Fed with 3 cuts now, and that's similar to 95 and 98, those insurance cuts. And so really, I think if we get more discussion around an additional rate cut, that's, I think, the key catalyst for sentiment to change to the negative, or continued no resolution around things that actually matter, like tariffs and Brexit.
Hey, I'm with you on the stock part of this, because at 20.5 times trailing, we're looking at the chart right now, it's the highest multiple on the S&P 500 since the September levels that we swan dived off at the end of last year. We're not to the 23 times, though, of 2017, and we're not to the 21 and 22s that we flirted with through a lot of 2018. So, John, what needs to give here? I mean, how long can we hang out at these levels without big uptick to guidance next year?
Well, apparently for a long time. And I think, again, that's, driven by quantitative easing and accommodative central bank policy. Really, you've got a lot of capital sloshing around the globe, trying to chase returns, which is why you see strong demand for risk assets across the board. Things like high yield and domestic equities have been really propped up by a lot of capital trying to find returns. And, until sentiment changes, I think we can hang out here for a while. You look at credit spreads as, the proxy to PE multiples, and credit spreads are pretty tight and can remain tight for a number of years, like we've seen through the last couple of years on the equity markets. But you do get drawdowns, and you have to be ready. And I think at this point, it doesn't cost you a lot to put a reasonable amount of portfolio insurance on. It doesn't cost you in the credit markets to trade up in quality. And I think what we've seen, and it's very odd, in this market where you're either a have or a have not. You're either in the high quality bucket and everything's safe, and you really need to make sure that what you own there is safe, or you're in the, very over-levered, cyclical type of bucket where nobody's willing to invest in that part of the market.
How do you define portfolio insurance or safety right now? Because again, I kind of come back to the way a lot of these asset classes were trading together, and we've now got moves in bonds and gold that have come off those highs from the earlier of the year. Stock market keeps chugging along. Sounds to me like what you're defining as being smart smart is in being insured is just sort of moving up on the quality spectrum. Is that going to be a better alternative than paying for options? Is it going to be a better alternative than building up cash or bonds or gold allocation?
Building up cash is fine, but you can't sit in cash permanently. As we've seen, you can have credit spreads tight for a long time and high PE multiples, and you can miss out on a lot of the upside of the market. But yes, I think you trade up in quality, and I think what we've said is you really want to be long analysts and short strategists at this point. You really need to focus on the micro, understand the safe companies that you own and why you own them, and worry less about the broad sector rotations.
Okay, John, right now, just to kind of bring it to the macro point that you made as well about central banks, to me it seems like compared to really just about any point over the last year, it seems like central banks are starting to step off the pedal a little bit. Am I reading that maybe you don't believe Powell is going to be on hold for cuts, that he's going to be forced to do more cuts? Tell me what you think about the nature of central bank accommodation now versus, the beginning of this mid-cycle adjustment, which we've been told is done.
Yeah, I mean, so from the Fed perspective, the Fed is really reacting to policy, and the Fed would not have engaged in rate cuts had we not had very poor policy as it relates to trade. So if we get a resolution, I would think that we're not cutting additionally. But if the rhetoric continues to ratchet up here, where we don't see a resolution, maybe we see additional tariffs put in place, and maybe that again translates into economic data, then the Fed might be forced to cut. So the Fed, we've said for a while, is really the residual actor here. They're responding to what we're seeing in terms of the administration and policy there.
Now, when we look at the credit markets, when you talk about credit spreads, they've been pretty tight. We can see on the BAML OAS that's been the case. One of the areas that we've also talked about here, I see in your notes, is in leveraged loans and some of the covenant light action that was happening over the last couple of years. We've used SRLN, BKLN, some of these ETFs that I know we've been watching. But from your perspective, what do you see in terms of the quality of these? Are they starting to erode? I mean, do you want to get out of this area? Is this going to be a sort of canary in the coal mine for the corporate bond market as a whole?
So from the loan space, if you haven't hit the eject button yet, you probably should. We've definitely seen a rapid deterioration in credit quality in the market. And people, again, this is kind of the strategist versus analyst analysis, where strategists will say loans look optically cheap, but the credit quality has deteriorated meaningfully. You look at the single B part of the market for the loan space, and that's gone from the mid-30s a couple of years ago to about 50% of the market, and that's come from the double B part of the market. And you really look and see who's the buyer in the loan space, and that's CLOs. And CLOs are very focused on this weighted average risk factor, this WARF score, where credit quality matters, and the lower the quality, the more onerous the charge is. And they have a cap on triple Cs that they can own. So as we've seen a lot of migration from double B to single B, now there's a big part of the market that could get downgraded into the triple C part of the market, and that would lead to forced selling in the loan space. And the largest seller, or the largest participant in this market, the CLOs, would have to be forced sellers. So I think that's part of the market that we would be shying away from. I wouldn't read into as much as the translation over into high yield bonds. There's some transmission mechanism, but the two markets are fairly disparate at this point.
So do you want to hit the eject button on the high yield bond market if you haven't already as well, or are there still areas that you can dabble in without getting burned from some of this credit risk?
Yeah, there's kind of the Goldilocks scenario going on in high yield, and I think that you have to, again, really be discerning in what you own. Broadly speaking, double Bs are overvalued, so you're paying too much for that safety and quality. Triple Cs are triple C for a reason, and be fearful of the yields that you're receiving. When something yields 15% at this point, it does for a reason. We think the single B part of the market is probably the best in terms of relative value and carry. But really, we're a proponent of trading up in quality and moving into the investment grade market, and particularly the triple B part of the market, where we think you get much better convexity upside, if we see rates actually go lower again.
Okay, John, really good conversation. Really interesting stuff here. Smart take as we talk bonds and the macro. John McClain is a portfolio manager at Diamond Hill Capital Management.